Hello, good morning or good afternoon, everyone. In this video, me and my partner are going to explain to you about our topic, PSAK 115, Revenue from Contract with Customer. But before we start the explanation, let us introduce ourselves first. My name is Eugene Kristania with student ID number 2024-50-126, and also my partner.
My name is Aline Gabriel Renata with my ID student number 2024-50314.
We're going to explain to you about what is this standard is about and also why is it exists and how it is actually work in practice. Okay, so before we jump to the PSAK 115 itself, let's first understand the two basic terms, income and revenue. So, because people often use them interchangeably, but in accounting, they are not exactly the same. So, income is actually a broader concept. It refers to any increase in economic benefits, and this could come from an increase in assets or a decrease in liabilities, and it results in an increase in equity, but not from owner contributions. So, income covers everything that makes a company richer in economic terms, except money put in by the owner themselves. The revenue, on the other hand, it is part of income. Specifically, it is the income that comes from the entity's ordinary day-to-day activities, like, for example, selling products or providing services. For example, if a clothing company sells t-shirt, the money from those sales is revenue. Because selling clothes is their main business, so it is their day-to-day activities to sell those t-shirts. But if the company sells on old delivery van that it no longer needs, or like their old vehicle, the profit from that sale is an income, but not revenue, because the selling vehicles isn't their core business or not day-to-day activities. So shortly, revenue is income, but not all income is revenue. Okay, now let's talk about why PSAK 115 was created in the first place. So, before PSAK 115 exists, revenue recognition in Indonesia was scattered across multiple different standards. As you can see in this table, we had PSAK 23 for general revenue, and then PSAK 23 that revised, PSAK 34 specifically for construction contracts, PSAK 44 for real estate development, PSAK 10 for customer loyalty programs, and then PSAK 21 for real estate construction agreements, and also PSAK 27 for asset transfer from customer. So we can imagine how complicated was that every industry basically had their own separate rule book for recognizing their revenue. For example, like a construction revenue followed one standard, and then a real estate developer follow another standard, and a retail company follow another standard. So it was very complicated. And this is also created inconsistency. Companies in different industry could recognize similar transaction in every different ways, which made financial statement harder to compare. And that's where PSAK 115 comes in. It is effective in 2020. PSAK 115 replaced all of the standard with one single comprehensive and principles-based standard. PSAK 115 adopted from IFRS 15, and it was developed as a joint project between IASB and FASB. It means that international and US accounting standard setter work together to create one unified approach to revenue recognition that could be used globally. So now, instead of having different rules from every industry, Indonesia use one standard that can apply to almost all types of revenue contracts. Now, let's take a look of the objective of PSAK 115. So the main objective is to establish principles about nature, amount, timing, and uncertainty of revenue and cash flow that come from contracts with customers. In simpler terms, PSAK 115 wants to make sure that when a company recognizes revenue, it truly reflects what was actually delivered to the customer, not just when the company received the cash. And this objective is achieved through three key ideas. First, revenue is recognized to describe the transfer of promised goods or services. It means that revenue should only be recorded when the company actually delivers what it already promised, not necessarily when the company is received the money. The second one, the standard requires entities or companies to consider the contract terms and all relevant facts and circumstances. So, judgment and context matter, not just a rigid formula. Third, this approach applies to both individual contracts and portfolio of contracts. So, it can be applied to transaction by transaction, as long as the result isn't materially different. And of course, PSAK 115 doesn't apply to everything. There are some scope of exclusion. The first one is lease contracts, which are covered under PSAK 30, insurance contracts under PSAK 104, financial instrument and investment in other entities covered by PSAK 110, 111, and so on, and the non-monetary exchanges between entities in the same line of business. For example, like two oil companies swapping oil inventories to fulfill customer order in different locations. This kind of exchange doesn't fall under PSAK 115. Now we get to the heart of PSAK 115, which is the 5-step model. So, 5-step model is a core framework that every company must follow when recognizing revenue from a contract with customer. And let me walk you through all 5 steps first, and then we'll go deeper into each steps on the other slides. So the step 1 is identify the contract with a customer. This is where the company determine whether a valid contract actually exists or not. The second one, identify the performance of the obligation. It means that company figuring out exactly what the company promised to deliver. The third step is determine the transaction price. So this is about figuring out how much money the company expect to receive in exchange for fulfilling the contract. And then the company can allocate the transaction price to the performance of obligation. So if there is more than one obligation, the company has to split the total price fairly between each one. And the last one or the last step is recognize revenue when or as the performance obligation are satisfied. So this is the final step, actually recording the revenue once the company has delivered the goods or services. Okay, now let's go deeper to the step 1, identifying the contract. So, under PSAK 115, a contract only exists for accounting purposes when all 5 criteria are met. The first one, all parties have approved the contract and are committed to fulfilling their obligation. The second one, each party's right regarding the goods or services can be clearly identified. The third one, the payment terms can be identified. The fourth one, the contract has commercial substance, meaning it actually changes the company future cash flow in some way. And the last one, it is probable that the entity will actually collect the payments it's entitled to. And if any one of these is missing, there's technically no contract yet under the standard. And there are also some special situation that we have to know. The first one is no contract. So if either party can walk away from unperformed contract with zero penalty, like a free trial, you can cancel anytime. And then the second one is contract combination. So if a company signs multiple contract with the same customer that are really part of one deal, they get combined and treated as one single contract. And then the third one is contract modification. So it is if a contract scope or price changes later on and the new items added are distinct and fairly priced, it's treated as a brand new contract. If not, it's just treated as a continuation of the existing one. And next is step 2, identifying performance obligation. Basically, it is figuring out exactly what the company promised to deliver. Each promise is either a single distinct good or services or a series of similar good or services delivered repeatedly in the same way, like a monthly subscription. But how do we know if a good or service is actually distinct? So there are two conditions and they both must be true. The first one, the customer can benefit from the good or service either on its own or together with other resources that are readily available for them. And then the second, the company's promise to deliver the good or service is separately identifiable from other promise in the contract. It means it's not so tightly bundled with something else that it can't really stand on its own. And some common forms of distinct good or service include selling goods that were produced or purchased and then performing a specific task, providing an ongoing service, or granting rights to use certain goods or services. And now, the important point is if a good or service is not distinct on its own, the company must combine it with other good or service in the contract until they form a bundle that is distinct. Okay, for example, imagine a phone manufacturer, let's say Apple, they sell iPhone that bundled with a custom operating system, which is iOS, that only works with that specific phone and can't be used separately. In this case, the iPhone and iOS might not be distinct on their own, so they'd be combined and treated as one single performance obligation, not two. Okay, now we can continue to the step 3, determining the transaction price. So it is the amount that the company expects to receive in exchange for delivering goods or services, but exclude the taxes collected for the government. And then there are some consideration here. The first one is variable consideration. So sometimes the price of the transaction is not fixed because of discounts, bonus, or penalties. And companies estimate this using either the expected value method or by the probability weighted average or the most likely amount method. So the company just picking the single most likely outcome. And this estimate can only be included if it's highly probable there won't be a big revenue reversal later. And the second consideration is significant financing component. So, if payment timing gives either party a financing benefit, like a customer paying 2 years in advance, the company adjusts the price for the time value of money. But if the payment gap is only 1 year or less, there is no adjustment needed. Okay, so the next consideration is non-cash consideration. So, if a customer pay to the company with something other than cash, for example, like share or goods, the company need to record it at its fair value. But if that's hard to estimate, they can use the standalone selling price of what they are giving up instead. The last consideration is consideration payable to customer. So if the company owes something back to the customer, like a cashback or coupon, it is usually recorded as a reduction of transaction price. But if the payment is actually for a distinct good or service the customer provide in return, it is treated as a regular business expense. The next one is step 4, allocating the transaction price. So once the company knows the total transaction price, the next question is, if there is more than one performance obligation in the contract, how do we split the price fairly among them or among the contract? The goal here is to allocate the transaction price to each performance obligation in a way that reflect the amount the company expect to be entitled to for fulfilling each specific obligation. So not just splitting it equally. And this allocation is done based on the relative standalone selling price of each good or service. It means that what each item would normally sell for on its own at the same time the contract starts. Nah, but what if a standalone selling price is not directly observable? So, PSAK 115 provides three estimation methods. The first one is the adjusted market assessment approach. So, the company looks at the market where similar goods or services are sold and then estimate the price that the customers in that market would be willing to pay. The second one is the expected cost plus a margin approach. So the company forecasts how much it will cost to fulfill that specific obligation, then adds the reasonable profit margin on top. The third one is the residual approach. So this is used only in limited situation actually, like when the selling price of an item is highly variable or uncertain. Here, the company takes the total transaction price and then subtract the sum of the observable standalone selling price of the other performance obligation, and whatever is left over becomes the allocated price for the uncertain item. For example, let's imagine a telecom company sells a bundle, a smartphone plus 12-month data plan. The data plan has a clear standalone price, but the smartphone standalone price is harder to determine because it's heavily discounted only within this bundle. In this case, the company might use the residual approach, like they take the total bundle price, subtract the known price of data plan, and whatever remains gets allocated to the smartphone.
So, on this slide, we discuss how the transaction price is allocated to each performance obligation. Under PSAK 115, when a contract contains multiple goods or services, the company cannot simply recognize all revenue at once. Instead, the transaction price must be allocated based on the standalone selling price of each product or service. For example, if a company sells software together with the installation service, the company must determine how much of the total price belongs to the software and how much belongs to the installation services. If the transaction price changes later due to discounts, bonuses, penalties, or contract modifications, the company generally use the same allocation basis that was established at the beginning of the contract. So this ensures that revenue reflects the actual value of each obligation delivered to customers. Revenue is recognized when the company satisfies its performance obligation by transferring control of goods or services to customers. PSAK 115 focuses on the transfer of control rather than only risk and rewards, which was emphasized in older standards. At the beginning of the contract, the company must decide whether revenue should be recognized over time or at a specific point in time. This distinction is one of the most important concepts introduced by PSAK 115. If revenue is recognized over time, the company must measure how much progress has been made toward completing the obligation. PSAK 115 provides two methods. The first is output method, which measures progress based on results achieved, such as milestones completed or units delivered. And the second is the input method, which measures progress based on resources used, such as labor hours, machine hours, or costs incurred. The company should select the method that best represents its actual performance. For example, construction companies often use the input method by comparing costs incurred with the total estimated cost to determine how much revenue can be recognized. PSAK 115 also regulates contract costs. There are two important categories. The first is incremental costs of obtaining a contract, such as sales commissions. These costs are recognized as assets if the company expects to recover them in the future. A simple example is when a salesperson receives a commission only after successfully obtaining a customer contract. A second category is costs to fulfill a contract, such as labor and materials directly related to a project. However, these costs can only be capitalized if they are directly related to the contract, generate future benefits, and are expected to be recovered. Otherwise, they are recognized immediately as expenses. After revenue is recognized, PSAK 115 also determines how contracts should be presented in the financial statements. There are three important accounts. First, contract assets arise when the company has performed work but has not yet earned an unconditional right to payment. Second, contract liabilities arise when customers pay in advance but the company has not yet delivered goods or services. For example, when customers pay for a 1-year Netflix subscription in advance, Netflix record a contract liability because the service has not been fully delivered yet. Third, receivables arise when the company already has an unconditional right to receive payment. These concepts improve transparency in financial reporting. PSAK 115 requires extensive disclosures to help users understand the company's revenue and cash flow. Companies must disclose information such as contract balances, remaining performance obligations, contract cost assets, and significant management judgment. The purpose is to increase transparency and allow investors to better understand how revenue is generated and recognized. In other words, PSAK 115 is not only about recognizing revenue correctly, but also about communicating that information clearly to users of financial statements. On this slide, we will look at three examples that illustrate how PSAK 115 is applied in practice. The first example is basic revenue recognition. PT Intan agreed to deliver goods on July 31st, while payment would only be received on August 31st. According to PSAK 115, revenue is recognized on July 31st because that is when the control of the goods is transferred to the customer. This means that the timing of cash collection does not determine when revenue is recognized. Instead, revenue follows the accrual basis principle and is recognized when the performance obligation is satisfied. The second example is contract modification. PT Siantar originally had a contract to sell 100 units at 1 million rupiah per unit. After delivering 60 units, the customer ordered an additional 20 units at 950,000 rupiah per unit, which is still considered the standalone selling price. Because the additional goods are distinct and sold at their normal selling price, PSAK 115 treats these modifications as a separate contract. As a result, the remaining transaction price is allocated prospectively using a new blended price of approximately 983,000 rupiah per unit for the remaining 60 units. And the last example, the third example, is multiple performance obligations. PT Melati entered into a contract to supply and install an elevator. Since the installation service can be performed separately from the delivery of the elevator itself, PSAK 115 considers them as two distinct performance obligations. This means that the company must allocate the transaction price separately between the elevator and the installation service. On this slide, we'll look at examples of variable consideration and significant financing components under PSAK 115. The first example is a construction contract involving PT Buana. The contract includes a base payment of 100 billion rupiah and an additional bonus of up to 50 billion rupiah, depending on how quickly the project is completed. Because the final amount depends on future events, this is considered variable consideration. PSAK 115 allows company to estimate variable considerations using either the expected value method or the most likely amount method. In this case, the most likely outcome method is used, and the company estimates that most probable transaction price is 150 billion rupiah because it has a 60% probability of occurring. And then, the second example is a significant financing component. PT Merapi sells goods with a cash selling price of 900,000 rupiah, but the customer pays using a 4-year zero interest note with a face value of 1,416,163 rupiah. Even though the customer will eventually pay more than 900,000 rupiah, PSAK 115 requires the company to recognize revenue at the cash selling price of 900,000 rupiah on the sale date. The difference between the cash price and the amount collected over time is treated as interest revenue and recognized gradually over the 4 years. Now, the last example is prepayment with significant financing. In this case, the customer pays 80,000 rupiah upfront, but the assets will only be delivered 2 years later. Because the customer pays significantly earlier than the transfer date, the company recognizes a contract liability first. Over the 2 years, interest expense is recognized. And when the assets is finally transferred, revenue of 89,888 rupiah is recognized. These examples shows that PSAK 115 focuses on the economic substance of transactions rather than simply the amount of cash received. This slide discusses two examples of variable consideration. The first example is the right of return. Suppose a company sells 100 products for 100 rupiah each and estimates that only 97 products will ultimately be kept by customers. Under PSAK 115, the company cannot recognize revenue for all 100 products immediately. Instead, revenue is recognized only for the 97 units expected not to be returned, resulting in revenue of 9,700 rupiah. The company also recognized a revenue liability of 300 rupiah for the expected returns and records an asset representing the right to recover inventory amounting to 180 rupiah. The second example is volume discounts. In the first quarter, the customer purchased 75 units at 100 rupiah per unit, and the company expects that the customer will not reach the discount threshold. However, in the second quarter, the customer purchases an additional 500 units and is now expected to qualify for the discount. As a result, the selling price is adjusted retroactively from 100 rupiah to 90 rupiah per unit. Therefore, previously recognized revenue must also be adjusted to reflect the new expected transaction price. So, this example demonstrates that revenue estimates under PSAK 115 may change as new information become available. The final topic is transition requirements. When companies adopted PSAK 115, they were allowed to choose between two transition methods. The first method is the full retrospective approach. Under this method, companies restate all previous reporting periods as if PSAK 115 had always been applied. This approach provides better compatibility between years, but it is more complex and requires more work. And the second method is the modified retrospective approach. Under this approach, companies do not restate prior period. Instead, the cumulative effect of adopting PSAK 115 is recorded directly in opening equity at the date of initial application. So this method is simpler and was chosen by many companies because it reduces implementation costs. So in short, the main difference is that the full retrospective method restates prior years, while the modified retrospective method only adjusts the current year's opening balance. So to conclude, PSAK 115 introduces a single and comprehensive framework for revenue recognition through its 5-step model. The standard emphasizes that revenue should be recognized when control of goods or services is transferred to customers, rather than simply when cash is received. By applying this principle, PSAK 115 improves consistency, comparability, and transparency in financial reporting across different industries. So thank you for your attention, and goodbye.